Ever wondered how investment banks actually make money? Of course you have. Everyone has, which is why there are 400 videos with this exact title, and every one of them promises the word actually. The truth, one layer deeper than the last video. Today we go all the way down. There are 7 actuallys between you and the answer. Bring the marker. By the end of this video, you will understand the business model of the largest financial institutions on Earth, in simple terms, and then in the actual terms, which are simpler and much worse, or better. It depends where you're standing, which, as you'll see, is the entire industry. Actually, number 1, the fees. An investment bank has divisions. Advisory helps companies merge and charges a percentage. Underwriting helps companies go public and charges a percentage. Trading buys and sells all day and keeps a sliver of every pass. Wealth management mines rich people's money and charges a percentage of it annually for the minding. So far, this is the version every explainer gives you, and it is true. It is also a menu, not a meal. Actually, number 2, one layer down. Advisory. 2 companies pay a third company to hold both their hands while they shake. Underwriting. The bank buys your company's stock wholesale in the morning and sells it retail by lunch, and the markup is called confidence. Trading. The bank stands in a doorway that everything must walk through and pats each dollar as it passes. Nothing here is illegal. Doorways are legal. That's the point of doorways. Actually, number 3, notice what every division sells. Not money. Banks rarely give you money. That's a different, sadder building. Not advice. The advice is a memo. What every division sells is position. The bank arranges to be between 2 parties who need to reach each other and charges a toll for the distance, which the bank also measures. It is the only business on Earth where you can own the space between other people's things. Actually, number 4, the fee schedule. Here is a number the explainers never say out loud. Take any client, a merging conglomerate, a retiree with a rollover, a sovereign wealth fund, a man with 1 certificate of deposit. Average the fees across the relationship. Every client at every scale nets the bank $1,890 a month. The big ones through complexity, the small ones through persistence. The schedule is not designed, it is observed like weather, and like weather, it is billed monthly. Actually, number 5, the trophies. When a deal closes, the bank commissions a small lucite block with the deal's name inside, a tombstone, which is the industry's own word, and the industry chose it. There are millions of them. They outnumber the bankers. The overflow is kept in a unit across town, shelves of embalmed transactions, floor to ceiling, each one commemorating a between that briefly existed and was told. In storage, nobody deals why. Actually, number 6, you may remember from another of our stories that the middle of the wealth ladder is missing. 11 unfilmable years kept across town. Here is the connective sentence this genre has been avoiding for 70 years. Nothing valuable goes unclaimed. The middle of every transaction on Earth was, at some point in history, unowned space. The investment bank is what happened when somebody noticed. That is the whole answer. 6 actuallys down. Investment banks make money because between every buyer and seller, every merger and target, every saver and market, there is a gap. And gaps left alone are free, and the industry's founding insight was that free is a market failure. They didn't build the river, they didn't build the boats. They bought the word between and licensed it back to commerce, per crossing, forever. There is exactly one man the industry cannot bill, and his file is thin. He pays cash in person for everything. He has never wired, financed, rolled over, or margined. Between him and the things he buys, there is no space at all. Windbreaker to counter, coupon to clerk. The industry's term for him is fully disintermediated, and the banks send him a card each year, the way you'd send a card to a lighthouse keeper, respectful, baffled, and a little afraid of the sea he lives on. Which brings us to actually number 7, and you've been ahead of us for a minute now. How does a finance explainer channel make money explaining how investment banks make money? Walk through it. Between you and the knowledge, there was a gap. We arranged to be standing in it. We bought your curiosity wholesale from the algorithm this morning, and we are selling it back to you retail right now. And the markup is called production value. The spread is the watch time. The advisory fee is the subscribe button. The tombstone is this episode, which will be kept, like the others, in a unit across. No, we said that one already. The point stands. Everything with a middle is an investment bank, and everything has a middle. And the genre you are watching is simply the retail branch of the same beautiful, terrible insight. You can own the space between a person and what they want to know. So, how do investment banks actually make money? Fees, spreads, and position, in simple terms. In actual terms, they were the first to notice that between is real estate. Everyone, since every marketplace, every platform, every explainer with the word actually in the title is paying them the highest compliment commerce has. Imitation at scale per crossing. Subscribe for more cinematic finance stories. We tell them in second person so that they happen to you. The toll was your watch time. Thank you for crossing.